What if some of the trading advice that you've been given over and over again is actually terrible advice? In today's video, I'm going to share with you 9 bits of trading advice from your fellow trading peers, but there's a big catch. I think some of them are flat out wrong. And rather than just telling you which one I agree with and which one I disagree with, we're actually going to play a little game. I'm going to give you each piece of advice one at a time, but before I go into sharing my opinion, I'm going to ask you to guess if the advice is good or bad. And here's what I want you to do. I want you to keep track of your score, and at the end of the video, let me know what you scored in the comment section below. And if you disagree with any of my opinions on them, even better. Just tell me which ones you got wrong, tell me why you disagree, and I think it'll be a great conversation topic for our comment section. Also, I have a feeling I'm going to reference a lot of books or videos or whatnot in this video. If I do, all of that information will be in the description box below. Oh yeah, do the likey thing as well. Now let's hop in. So we'll start with an easy one just to get you warmed up, and that way you don't think I'm trying to trick you or anything like that. So this could be your freebie. Number 1, don't system hop. And what system hopping is this? System hopping is the act of a trader jumping from one system to another system. Not because they gave the system time, not because something else changed, but simply because they got bored or they thought the system failed. In many cases, a lot of traders get into trading with this false assumption, internet gurus, that a trading strategy has this super high win percentage. I'm talking something that wins 90% of the time, something that wins 80% of the time, even 70% of the time. And although, yes, I'm sure there are strategies like that and you can mold and make your strategy like that, the truth is most trading strategies have an edge that is very, very small, meaning they don't win at that high of a clip, but the money is made by consistent performance and probably a consistent risk reward as well. So what happens is that when a trader finds a new strategy, wherever they find that new strategy at, and they start trading it, sometimes it starts off pretty good. They get a couple wins and everything is great. They start calculating and thinking about all the things they're going to buy with all their new trading profit. But like any other strategy out there, eventually it is going to go through a rough patch. It is going to go through a drawdown. It is going to go through a period where it just loses. And for professional traders and traders with a professional mindset, that's okay, right? We take our wins, we take our losses, we know our percentages. At the end of the day, law of large numbers, we are still going to come out with the edge. But a trader with false expectations, mainly due to not doing their back testing and having no idea what the numbers actually are, well, they all of a sudden think their strategy failed, or it's not working anymore, or it's broken. And instead of kind of waiting it out, right, suffering through that pain, they take the easy way out and just jump to the next strategy. The secret is they simply repeat the process over and over again and continue to spin on that magical hamster wheel of wasting time and making no money. So 100% completely true. Don't be a system hopper. Speaking of systems and strategies, we'll head over to number 2. Start with a mechanical strategy. What do you guys think about this one? For me, this bit of advice is going to be negative. Now, it's not that mechanical strategies are negative and mechanical strategies are like automated strategies or even something that is using indicators only, so no kind of you involved in it, like discretionary trading where you're breaking down and you're observing and your opinion kind of plays a role in it. I'm not saying there is anything wrong with it, but you certainly don't have to start with a mechanical strategy. You can be a price action and discretionary trader just as much as you can be a mechanical trader, right? It's really all up to you, your desires, and what you're actually good at. Another bit of advice that I took out of it that kind of piggybacks on this is also find a strategy that suits for you. And many of you guys may not know this, but when I first started in trading, at least the Forex market, and I got into technical analysis, I actually wanted to be a mechanical strategy trader. And the reason is because it was pretty simple. I just look at a chart, and when the thing does the thing, I push the button and it does the thing and I make the money and life is good. However, what I found out by investing a lot of time and a lot of money losing trading mechanical systems is that it just didn't mesh with my personality. Now, this also had a lot to do with me being young and not very psychologically disciplined in the market, but the problem that I had with mechanical strategies was that I also had an opinion about the market, meaning deep down inside of me, I was a price action trader. I liked looking at the charts. I liked breaking it down. I would generate an opinion based on what I saw. However, when I was following the mechanical strategy, sometimes it would give me a signal that was the complete opposite of my opinion. Now, because I was trying my best to be disciplined, I would always follow the rules of the mechanical strategy. But when that mechanical strategy lost, I would get very upset and I would be like, I knew I was right. I should have trusted my gut and my opinion, and the system is stupid. And what happened is a very small crack formed in my trust for the strategy. And over time, as I got more instances like the one I just told you about, that crack got bigger and bigger and bigger to the point where I really didn't trust my strategy at all. And well, once I didn't trust it, the floodgates opened up and all types of psychological mistakes happened. I would move stops back out of fear. I would take targets early out of fear. I would skip trades. I would take signals that weren't there. And it just ended up being an epic failure. And the lesson was that for me, I was a discretionary trader. That was the path that suited my personality the most. That's what I was most comfortable with. And it didn't have to be a mechanical strategy. So again, nothing wrong with being a systems trader. Nothing wrong with using indicators or an automated trading strategy. There are all types of benefits to it. I'm just saying you don't have to. And if anyone tells you that you do, they're wrong. Next up, learn risk management and don't trade too big. And I actually want to read to you a little, I think it's an excerpt from a book, but I thought it was really, really cool. So it says, reduce your position size by 75% right now. You're trading too big. And again, obviously this isn't for everyone, but the point is that a lot of traders are trading position sizes that are way too big. And the first step you should do is reduce that. Now it says, not maybe, not if it feels uncomfortable, just do it. Cut everything to 25% of what you're currently risking. Why? Because your biggest edge as a new trader is survival long enough to learn. Amen to that. And oversized positions will kill your account before you develop the psychological capacity to manage them. And just to pause real quick and to sprinkle in my little opinion on that, one of the first things that I had in my trading plan, which is somewhere in this 3-ring binder right here. And that's how old I am and how old my trading plan is, that I actually had it in 3-ring binder. But one of the first things I put in my trading plan / business plan when I first got started is that I believe the only reason people fail is because they give up before they have the chance to be successful. Meaning that if you think about that meme or that graphic where it's like two miners that are mining and digging under the ground, and then there's like one that's one chop away from like diamonds and gold, and the other one that's also one chop away, but he's walking backwards. I believe that's what success is, right? You will be success if you take the right actions in the right way with the right amount of effort over the right period of time. And the problem in trading is this. A lot of traders are out there putting in effort, but they run out of time. And they run out of time because of what the trader just mentioned here. Perhaps they're risking too big and they blow their account, and they just don't give themselves enough time to learn and adapt and get those lessons that other traders would. So always start small. As a newer trader, you're going to make the most of your mistakes at the very beginning of your trading career. So it just makes sense to be more cautious while you're at your absolute worst. But it also gives yourself time to learn lessons and to actually grow and develop as a trader. That way, when you do get good, you still got some money in the bank to play in the markets with. But back to the quote. You think you're risking 2% per trade, but when that loss hits, you'll move that stop. Then you'll revenge trade. Then you'll overtrade trying to recover. That 2% becomes 15% in a single session because you don't yet have the infrastructure to prevent psychological casualties. Trading with a small size gives you room to make mistakes without catastrophic consequences, emotional space to learn pattern recognition, psychological safety to develop decision-making skills under actual market pressure, and time to build systems in Chapter 12 before you need them desperately. I don't know what Chapter 12 is. Again, haven't read this book, but I'll share it with you at the end. Your goal for year one isn't profitability. I agree with this as well. It's building an unshakable psychological foundation while preserving capital. Can't do that if revenge trading a full size blows up your account in month number 3. Stay small, stay alive, learn psychology first. And again, the book is called, looks like it's called The Psychology of Trading Losses by Luke Arden. I have not read it, so I can't tell you if it's a great book or not, although I do like this excerpt from it, but I'll link it below if you guys want to check it out. Shoot, I may even buy it myself after reading that. That was pretty darn good. Anyway, I'm not sure if I said this or not, might have forgot, but I 100% agree with that as being good advice, if you couldn't tell already. Next up, stay off the hopium. I got to do this because it's my thing. Whew, right? Hopium is one of my favorite words, right? Hopium is pretty much, instead of like making decisions in the market off of technical and tactical things, you're just praying that price doesn't do the thing that you don't want it to do, and you're hoping that it will reverse before you get taken out. And that is not a very good way to live. It is very stressful, and there's no consistency in it. There's a quote underneath this one that said, "To my fellow traders, a stop loss is not a failure. It's a professional and strategic exit. Stop holding losses based off of hope. That's why 40% win rates in the market can still be profitable." And I agree with this 100%. So if you said good advice, then good for you. Check yourself off another win. But to dig into it a little bit deeper, I agree 100% because one of the most difficult things about trading in comparison to like our normal life is that there isn't a black or white, right or wrong. If I take a test and the teacher has a true or false answer, it's either right or wrong. And I'm graded well if I get everything right. I'm graded poorly if I get everything wrong. It's simple. And everything in life is kind of judged off that, right? If I do good at my job, right, I'm good is a metric provided to me by my boss, and it means that I'm doing well and I get promoted. If I'm doing bad, which is also a metric, given to me by my boss, I get fired. Trading is a little bit different, right? Because in trading, we can do everything right and still get the wrong answer, right? It's very similar. Both my boys had soccer tournaments this weekend, and one of them, we had a lot of shots on goal, but we just couldn't get the ball in, and we lost the match. And our coach said, "Hey, you guys played well. You deserved to win. You just didn't. Sometimes soccer is cruel." And a lot of the boys were crying, but it was like, hey, you did everything right. It just didn't go in. And sometimes that's it. So when it comes to trading and we have a losing trade, obviously one that hits our stop loss, the first thing that we do is assume that we're wrong. And how do I know? Because I've done it myself and I've worked with hundreds of thousands of traders over the last, decade and a half. And I get the question all the time, "Akil, I took this trade. Look at this chart. What did I do wrong?" And many times there are things that you did wrong or things that you could have done better or things that you should take notes on for the future. But sometimes it's also like, hey, man, you did everything right. Actually, I was in the same trade and lost too. So let's have this pity party together. And that is the dynamic of trading. We have to learn to judge ourselves off the process and not the outcome. If we follow the process, meaning our trading plan and our routine and all that fun stuff, we can do everything right. And we may be right sometimes, we may be wrong sometimes, but we have to give ourselves a thumbs up for following the process because we know, bigger picture, because our trading strategy has an edge, if we follow the process religiously, we are going to extract that edge. And that means the maketh of the money. Next up is going to be keeping a journal. Pause the tape if you need some more time to think about it. But I think this is absolutely great advice. We spoke about having an edge. We spoke about following a process. Well, keeping a journal is a very easy way to ensure that we are following our process. It is also ways to see if our edge is going to deteriorate, right? A few episodes ago, I gave you guys a I think an audio only episode about how to determine if your strategy is failing. No, it was video as well. So go and check that out. But strategies do fail over time. Strategies do decay over time. And you don't want to be one of those traders that realizes that too late because all your money will be gone. But if you're consistently journaling, you're going to be able to catch any red flags, or I guess orange flags, yellow flags that turn into orange flags. You're going to catch all those things before they turn into red flags. Real quickly, while we're on the topic, on August 28th, we are launching the brand new Tier 1 trading website. It is awesome. It looks better. It is smoother. And we're introducing a lot of cool tools. And one of those cool tools is going to be a brand new trading journal. We got a brand new 90-day planner as well that looks amazing. If you're interested in checking that out, make sure you sign up. It's a free training event that we're going to host. So come because it's free, but you also get to see what those brand new tools look like as well. So August 28th, link in the description box below. But back to the point, journaling is important. I'll leave it with this. As traders, we are typically independent, meaning that unless you're working for a brick and mortar prop firm, there isn't someone overseeing the things that you are doing and helping you make those corrections. You are independent. You are trading by yourself and you are your own boss. And that is great because as your own boss, you can create your own schedule, you can create your own rules, you can do whatever the heck you want. But that is also bad because as a boss, you can do whatever the heck you want, meaning that there is no one to sit back and audit you. So if you aren't being accountable for tracking your results and tracking your mistakes and making the adjustments that are necessary based off those mistakes, you're going to fail and no one's going to be there to catch you. And if you're someone that doesn't like journaling, like me at the beginning of my career, because I thought a diary was girly and stuff like that, there are other ways to do it too. Back in the day, I started by creating a blog. It was for me personally, but it was also public and people found it and that's how they found out about me. But pretty much what I was doing is I was journaling every day because I had to track my feelings, all that fun stuff. And just the process of knowing that I had to do this every single day and I had to write out a whole blog post about all the dumb mistakes that I was making because I was a pretty bad trader back then. One, it allowed me to realize and accept that, hey, I am making mistakes. And that's probably the reason that I suck as a trader. It's not the market, the broker, the weather, whoever else. It's me because I just wrote down 10 dumb things that I did today. Two, it really brought me kind of a community, right? I was part of a trading community at the time, but we weren't really a trading community, right? Tier 1 members, you know that we're all together on a chat and we talk to each other. We hold accountability sessions. Like many of you guys see each other in real life, which is really, really cool. For me, I was part of a training community, yes, but we never really interacted at all. So like I knew names, but I didn't really know much about them. So having this journal allowed people to reach out to me in the comments and say, hey, Akil, I'm happy to read that you suck because I suck too. And I know that sounds bad, but misery loves company. And it just, at the time, I felt like I was the only one in the world that was bad because Twitter and whatever forum I was hanging out in only shared their highlights. So it just kind of gave me confidence that I was in a bad place, but I could work through it. Another way to journal, and this is going to be very helpful for your trading as well, is to record videos, right? Maybe when you're doing analysis, right? Pre-analysis or maybe post-analysis or even during trade analysis, just click the record button and like self-narrate. Then you can go through it and it's like reviewing film, something that many of the best traders in the top prop firms do, something that many of the best athletes do as well. It's a really good tactic to take if you want to improve your trading really, really, really fast. All right, next one. Cut your winners early. And what I mean by cut your winners early is like, don't let a win become a loss. What do you guys think about this one? This one sounds amazing, right? Cut your winners early, right? Win is good, loss is bad. Don't let good become bad. Perfect, right? But actually, it's going to get the thumbs down from yours truly. Because this is just a fancily wrapped way of saying take profits early, which is a big no-no. And again, it does sound great, right? You don't want a winner where you maketh of the money to turn into a loser where you loseth of the money. But if you remember what I said about process and process being the most important thing, cutting your winners early is doing nothing more than sabotaging your process. And here's a story that I have. My best friend, who was also a fellow trader, he's the one that got me into Forex to begin with, he is one of the best system developers I've ever seen. I don't understand how his brain works, but he has this knack for looking at indicators and putting together in a way that just works really, 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 really good. Unfortunately, he was never profitable as a trader. He's a really profitable options trader now, but back in the day as like a Forex trader, he was never profitable. And the problem wasn't his system or strategy. It was him. And it all started with one trade. He had one trade that hit this big runner. And let's say my hand here is my target profit, and price action came all the way to that target profit, looked it in the eye, maybe like 3 or 4 pips away, and then turned around, crashed down, and took him out for a loss. So he was extremely close to making a lot of money, and he left with less in his account than he came in with. And what he told himself was, That ain't never going to happen again. So the next time that happened, where price came about 5 pips before his profit target, instead of letting price run up to his profit target and get what he was supposed to get out of the trade, he took it early, right? 5 pips, no harm, no foul. I think, if no one was looking, all of us would probably do the same thing, right? If you said yes, no, that's horrible. Wrong answer. I tricked you. Bad answer. Shame on you, right? But seriously, most of us would probably be like, 5 pips, it's worth it, right? But the problem was this created a very bad habit. So he started off with a profit target here, and then he would routinely take it 5 pips away because it was close enough, right? But then 5 pips away from his initial target profit turned into 5 pips away from his new 5 pip away target profit, which was 10 pips away. And you can see where I'm going here. It kept getting bigger and bigger and bigger to the point where he was taking his profits off at about the halfway point of his profit target. And for him, he justified it because he's like, hey, I'm not going to let this winner turn into a loser. But his trading account did not like it because he was no longer exploiting his edge. His win percentage wasn't great enough to keep up with the shift in risk reward that he put into his trade by, self-sabotage. And he ended up losing a lot of money. So although it sounds good in theory, it's not good in practice. Our target profit shouldn't be in a random place. It should be in a place that we believe price is likely to go to based on our analysis. And yeah, there are going to be times where we are unlucky. I've had plenty of times where price action looks me in the eye and smooches at me and then turns around. It's going to happen. But bigger picture, it's going to be a lot more profitable if we consistently take our targets out where we were supposed to take our targets out and not take those profits early. Trust me. Next up is trade what you see. And while you're thinking about your answer, I think this is also a really good book. It's a really good introduction book if you're interested in harmonic patterns. I think they have bats and Gartleys and butterflies in there and AB equals CDs and stuff like that. Just kind of the ebbs and flows of how price moves. Good starter book. One of my favorite books on technical analysis for beginner traders. So yeah. Anyway, this is going to be a double thumbs up for me. I think it is great advice. You always want to trade what you see, not what you think or not what you want to see. And this is something that happens a lot during slow markets, right? I was talking to one of our tier 1 members the other day on the platform, and he said, man, Akil, summer is hard. And I'm like, well, why is that? I've been having a really good summer trading patterns and blah, 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 blah. He's like, well, because there's not as many signals as I thought there would be, right? I got into trading and I'm thinking I'm going to be in front of my screens. I'm going to be clickety, clackety, bang, 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 firing off trades like a wild cowboy. And I came in here and there was 2 possible trades and none of them actually got to my entry. And I'm sitting back and I'm just like, okay, am I really a trader? And he went on to say that to make things worse, he would kind of go onto the social media and he would see everyone else talking about all the money they're making today. And he kind of felt left out or that he might be missing something. So what he did was he went onto a chart, redid all his analysis, and instead of saying nah, nothing, it started changing. His mind started saying, well, what if, or I could, or maybe. And eventually that boredom led to him deviating from his plan. He took some trades he wasn't supposed to take, and he ultimately lost money. And it's all because he wanted to see something that wasn't there. So I know it's hard. Traders want to trade. It's hard to stare at charts for however many days you're staring at the charts and not take anything. But my advice is this: follow your process, go through your analysis. If there is nothing there, find something else to do, right? There should be plenty of things to do on your trading to-do list. So use that extra time that you have now from not actively trading to backtest, to strategy develop, to review some courses, to read a book. Shoot, go play with your kids, be a good parent, right? Something to get your mind off the markets, because if you stare at them long enough, you will create something that isn't there. Last one, cut losses quickly. And this is another one that's going to be iffy, and I was kind of on the fence about how I wanted to judge it, so I'll give you guys a little bit of grace here, but I'm going to say no, and this is mainly based on my interpretation. So you can change it if you interpret it a different way. Yes, we want to cut losses quickly, but we want to do it in a certain way. The way I interpreted this when I saw cut losses quickly is that they meant cut losses prematurely, meaning that if a trade is not going in your favor, exit it right away before your stop losses hit. Just like my opinion on targets is that price action, you should allow price action to hit your target to prove that you're right. You should allow price action to hit your stop loss to prove that you're wrong. Now, again, there's all types of active trade management and risk management techniques that you can take. If you get a certain candle, it may mean a certain thing, and that may invalidate your signal, and you may have it in your rules. If my original signal is invalidated, then I can exit at market. So I understand there's like a wide range here. But when it comes to the basic kind of idea of like, unrules the base panic, like, oh my gosh, there's a red candle forming and I'm in a bullish position, the market must tell me I'm wrong, I got to get out early before I lose even more. And then you're like, yes, I lost, but I lost less than what I planned on losing, so that's a good thing. No, that's bad. Remember, just like profit targets, stop losses aren't random. We're just not closing our eyes and throwing a stop loss somewhere on the chart. A stop loss is purposeful, right? My belief on stops are this. My stop loss should be at the place where if market gets there, I know that I'm wrong. So if there's like a level of structure here, my stop loss is below that level of structure because this level of structure is my final protection in the market. And if price takes it out, I'm wrong. And if I'm wrong, I want to be out of the trade. With that being said, we also want to give our stop loss enough breathing room. If this is my level of structure right here, and my stop loss is like a micro pip below it, we know what's going to happen. Stop hunters, liquidity grabs, squeezes, right? They're going to get you. So yeah, you do want to give the market enough breathing room to kind of do its dance and kind of get all those rookie traders out of the market. But I don't necessarily think we need to adjust our stop loss prematurely. So again, this one's a little bit of a weird one. It's going to get the thumbs down for me, but hopefully my interpretation kind of explained it to you so that you can have the right answer. Speaking of the right answer, again, let me know below in the comment section what you scored. Let me know which ones you got wrong. And if you disagree with them, let me know so we can have that discussion. And if you love quizzes, let me know that you love these quiz videos so I can do more of them. And check out this other quiz video that is based on trading strategy and technical analysis. I'll see many of you guys August 28th for the Tier 1 Trading new website launch party. And until then, plan your trade, trade your plan. Take care. Go Toffees!